Welcome back. You're still watching Mutual Fund Corner here on CNBC TV18. Well, Motilal Oswal recently put out a report that shows how passive funds have taken center stage in the mutual fund industry over the last few years. We've seen this segment gain market share from 1.4% of the total AUM in 2015 to over 17% today. At the end of FY18, the AUM of all passive funds combined stood at 83,000 crore rupees. This number now stands at over 7 lakh crores. This means we've seen an 8.5 times rise in just 5 years at a staggering CAGR of 54%. We have with us Pratik Oswal, who is the head of passive funds at Motilal Oswal AMC, to discuss about this report and everything about the passive category when it comes to mutual fund investing. Pratik, thank you so much for joining us on Mutual Fund Corner. Well, the numbers are mind-boggling, definitely. But according to you, why do you think we've seen this big rise in passive investing? And where do you think we'll be in another 5 years in terms of market share?
Yeah, hi. Thanks for having me on the show today. I think if you look at passive funds as a category, we've seen a lot of growth in this side of asset management over the last 5 to 7 years' time. As your report said, this category was, I would say under 20,000 crore in total assets in 2015, and today it's almost 7.6 lakh crore. And although a lot of it can be attributed to the employee pension EPFO, they will be the largest investors in passive funds. But we've also seen that there's a lot of interest from investors coming in from all sides. So we saw huge institutional and family office interest coming into passive funds. We saw new categories being created from nowhere. You had fixed income passive funds which were virtually zero about 5 years ago. You had international funds which were virtually zero 5 years ago. You had gold and silver commodities which were also very small. So you're seeing a lot of creation of new asset classes in this segment, and that's what's led to the rise in passive funds over the last 5 to 6 years.
I mean, I can imagine that if you've launched a microcap passive fund, I can imagine the kind of, demand that there is. But we'll come to that in a bit. Pratik, I was going through the report and you've said that over half of the respondents said that they increased their allocation to passive funds in just the last 12 months. What do you think has changed so materially in this period, in the past year or so?
Yeah, so I think one of the biggest barriers towards adoption of passive funds was actually awareness. And what we've seen with so many launches that have happened in the industry, from a lot of AMCs coming in, that the awareness towards passive funds have gone up dramatically. Second is investors in this survey also what my experience as investor, like a lot of simple products. What we've seen in the investing world is today you have hundreds and thousands of products out there, and I think passive funds today really do a good job of keeping it super simple. One of the big I would say triggers for why we're seeing so much interest from investors is that compared to say 5 or 6 years ago, where there was a clear advantage of active funds over passive funds, and today what we've seen is that the difference in returns is actually quite small, in fact almost zero. So I think investors have realized that passive funds is not only a good asset class where you can get simpler products, but also returns are pretty much the same. So I think that's one of the big triggers that have happened over the last 5 years.
Okay, and if we talk more about the report as well, interestingly, investors seem to have a preference for index funds over ETFs. This is actually opposite to what we've seen in some other countries such as the US. Is this a trend that you think will continue in our country?
Yeah, so it's very interesting because in the US, if you compare ETFs versus index funds, there's an obvious advantage of ETFs because they have a slightly bigger tax advantage, so inherent tax advantage built into ETFs. So I think you have to be really not smart to choose an index fund in the US. Whereas in India, I think, both are pretty much exactly the same in terms of their tax advantage and disadvantages. In fact, what we've seen also from our experience is that people tend to prefer index funds because a lot of our investor base does not have demat accounts. They want to set up SIPs. And also and with ETFs in India, they tend to be very illiquid. So a lot of investors today, suffer from, I think buying impact cost, which is, overbuying for ETFs and selling them for less. So I think the mutual fund format really makes it very easy for investors to invest into passive based funds. So I think that's one of the main reasons to why we're seeing index funds becoming a lot bigger. Unlike the US, we believe that there is a very I would say investor profile that likes ETFs versus index funds. So if you look at institutions, family offices, pension funds, they tend to prefer ETFs. Whereas if you look at say retail investors, HNIs, they have a strong preference towards index funds.
Okay, got that. That's on the index funds versus ETF part. Pratik, your survey also shows that investors are most concerned with the expense ratio of a passive fund when making a decision about, which one to really pick. This is then followed by the brand of the mutual fund house, AUM of the fund, and then comes the tracking error, right? I would think that the tracking error should be higher up in that list. But is there anything that you would like to tell an investor who's getting into passive funds, perhaps is not too, comfortable in the market and is just getting started? And what would you recommend in terms of a checklist when you're picking one fund over the other?
Yeah, so I think I completely agree with you. Tracking error is super important. In fact, I think as someone who is looking at passive funds, my number one job is to make sure that the funds that we run are super efficient.
Yeah.
Because how much ever sales and marketing you can do, if your funds are inefficient, no one's going to invest in them. So I think tracking error is very important. But but we still believe that in terms of investor awareness, people still seem to find hard to understand what really tracking error or tracking difference means. So I think over time you'll see that there's a lot more awareness coming in. But as of now, I think people are really lured by the sort of expenses of I think index funds and ETFs. I think people like the fact that more of your money is invested into the underlying stocks. And I think over time what we've seen is that that has been a main driver for why passive funds have performed really well. The other reason to why costs are important is because the lower the cost, the easier it is for you to track the underlying index. What we've seen is that the funds that have a lower sort of inherently funds with a lower expense ratio have a lower tracking error. So I think that's one of the reasons to why also costs become very important for investors. I think it's very important to understand that today the way the market has evolved over the last 5 years, the differences between one AMC's Nifty 50 versus other Nifty 50 is actually quite small. So I think the recommendation to investors is to sort of really go with the AMC you trust. That's very important. I think you should not go with the AMC with a lower expense ratio, but you don't have trust in them because you don't know what might happen in the next 5, 10, 15 years time, because obviously you're investing for a very long time. So I think the AMC trust is very important. And secondly, even between ETFs and index funds, I think you should really go for something which is convenient to the investor. I think that those are the two things which are very important.
Okay, so Pratik, just tell us more within the passive space. Are you seeing high interest for mid caps or small caps or sector funds for that matter? Because we've seen several new launches in these pockets as well, and this category has done really well in the markets.
Yeah, so I think if you look at the current flows within passive funds, they are I think most of it is in the large cap space. In fact, what's funny is the large cap space had a share of about 38 or 40% 5 years ago, and today it's 60%. So there's incrementally also a lot more money coming in large caps, which is the Nifty and Next 50 is where most of the demand is. But increasingly, you're seeing a lot more sort of innovative passive funds coming in the market. We were the first ones to launch a mid-cap, small-cap, Nifty 500, which is an all-market fund. You have sector funds coming in, ETFs. You have also micro-cap funds. So I think, I think if you look at, say, the category, you don't only have equity, you also have fixed income, you have multi-asset passive funds, and now hopefully next year you'll also have hybrid passive funds. So I think there's a lot more innovation that's going to happen in the industry. And we believe that obviously currently most of the demand is happening in the large caps. But increasingly, you're seeing more and more flows coming into sectors, as well as sort of the other capitalizations, which is basically where people want simpler products over sort of other funds.
Okay, that definitely makes sense, and it'll be interesting to see all of these new launches. But speaking of the new launch, your microcap passive fund, how has the interest been, Pratik, in this one?
Yeah, so the interest has been actually quite overwhelming. I think. It was a very successful launch. I think the AUM is more than doubled just in the last month and a half. And in fact, the fund is also up about 11% already since launch. So I think the interest has been there. I think people do want access to new categories. People do want sort of innovative new funds coming in the market. And so I do feel that I think, yes, you will see a lot of these launches coming in over the next few years or so. I think this category may not be as big as the other categories because still I think market depth may be limited. We as a fund house may have to limit our sort of money that we can collect in this particular fund. Maybe not now, but maybe in 3 to 4 months time. We're obviously monitoring so this fund very closely. But we do believe that I think this category really opens up to a lot more sort of innovative funds that could come in over the next few years.
Okay, all right. Looking forward to more products from your fund house and the others as well. Pratik, thank you so much for joining us today and taking us through everything about passive funds, actually. And with that, we'll do one thing. We'll take your leave on this edition of Mutual Fund Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.